Hello, and welcome to the Three Questions Podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. If you or someone close to you is a successful business owner paying significant taxes and looking for smarter, more creative ways to keep more of what you earn while planning for the future, stay tuned. Our topic, the three questions intelligent business owners should ask about creative tax planning. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions Podcast, please consider liking this video and subscribing to our podcast and YouTube channels. For successful U.S. business owners, the tax burden can feel relentless. After years of building a company, many are shocked by how much of their hard-earned profits disappear to federal and state taxes, especially around major events like selling a business or acquiring new real estate. Creative tax planning isn't about loopholes. It's about legally structuring operations, timing transactions, and using available incentives so you can keep more of what you earn while still growing and protecting your wealth. So today we're going to explore the three questions intelligent business owners should ask about creative tax planning. Joining the Three Questions Podcast from West Palm Beach, Florida is Mike Anthony. He's a CPA, a strategic and tax advisor to business owners and high-income professionals. He has over 2 decades of experience that includes public accounting and executive CFO roles. Mike operates at the intersection of tax strategy, financial performance, and long-term wealth planning. Mike helps a select group of clients nationwide to implement highly customized, proactive tax strategies designed to reduce liabilities, enhance cash flow, and improve profitability. Mike, love having you on the podcast. Great to see you. Thank you for making time for us today.
Nice to see you, Wayne.
Thank you. And, we got a lot to cover today, but there's something we get to spend quite a bit of time in West Palm Beach here, and one of the things I learned about Mike that's really interesting is that he is a very, very active in paddleboarding, and I'm about, I don't know if I ever told you this, Mike, but I'm about 11 miles as a crow flies from Malibu.
Oh, wow.
And it's not unusual. When I lived in Malibu there for a few years, I lived right on Zuma Beach. And I used to be able to look out of the balcony where we lived, and you could see paddleboarders slowly making their way across about 100, 200 feet out. Out with the dolphins, you'd see people on paddleboards. And I never much thought about how far they were, going, the distance. But when we were talking back when we were in West Palm Beach, you had mentioned that you had done something like you were raising money for cystic fibrosis, and you did a fundraiser where you paddleboarded something like 85 miles from the Bahamas to Florida. Can you just maybe share a little bit about how that all came to be?
Oh, sure, yeah. And it's actually that time of year again, every year for the past 13 years. There's a group called Piper's Angels, and there's about 200 paddlers that go from Bimini to Lake Worth, Florida, which is about 80 miles. Takes about 15 hours, and it's all to raise money for cystic fibrosis.
That's something
It's a
else. And
great
and you yeah,
cause.
and it's done overnight though, right? You don't do it in
So yeah, so you start at midnight at Bimini and just head out into the dark ocean. You can't even see Florida from there. And sometime the next afternoon, you end up on the beach in Florida.
That's something else. And there's like this, you said there's like a current that sort of helps drag you along or
Right. But yeah, we take advantage of the Gulf Stream, definitely. The Gulf Stream, we start a little bit south of where we're going to end up. So the Gulf Stream heads north. So kind of cross the Gulf Stream diagonally. And hopefully there's a wind coming from the east that helps us as well. So, but you never know. That's one of the things about the whole thing is you have to rely on nature. You don't know what nature's going to do. So
well, I'll
definitely
tell
an
you.
adventure. Yeah.
Well, kind of in a way, near and dear to me because, I was saying to you before we went on the air, I had the family that adopted me. The reason they adopted me is they had 3 of their babies die from cystic fibrosis. This is back in
Oh,
the 1950s. So yeah, it's quite the story and obviously a great cause. And, I'll tell you, anybody that can paddleboard for 80, 85 miles is I'm tipping my hat to you for that.
And
It,
this group is able to raise about $1 million a year just through this one event.
I would
So
imagine.
they've come a long way in helping the pe people with cystic fibrosis, like you mentioned. Uh, Kids used to not even live that long.
Well,
So,
there you go. And that happened in I think in my family. I think my oldest, I guess, of the three that passed away, I think she didn't live much past 2 years old. The other ones didn't make it to a year old, as I recall.
right. So this group is able to help people in that situation and provide medication and support and all that kind of stuff.
Amazing.
So,
All right, man. Well,
yeah.
I couldn't let that go by because when we were
Uh,
chatting, it was like you paddleboard
eh,
80 miles. I guess, holy smokes, that's something else.
oh
I guess
yeah.
maybe for paddleboarders, like, no big deal. But for a layperson like me, that's quite a feat.
Yeah. Nice.
Mike, yeah, before we dive into the three questions, I'd love to get your perspective on the current landscape, tax wise. What are some of the biggest tax related challenges you're seeing among successful business owners right now here in 2026? What's really kind of rattling everybody's pots and pans right now?
Yeah, well, I would say the biggest challenge currently is we have a lot of changes, specifically the One Big Beautiful Bill Act. Um, and not everybody knows what all the changes are or how to even follow them or document them. But um, the biggest challenge is probably like understanding and leveraging the changes in the bills and how to take advantage of the strategies to reduce your taxes further related to that. There's also like higher scrutiny by the IRS, even though they didn't hire quite as many people as they were
The
going to.
85,000 new agents that they were telling us they were going to hire?
Yeah. Even though they don't have the 85,000 new agents, they're still scrutinizing, especially high earner W-2 and pass-through entities like S corps. So it's even more and more important to document everything properly.
What tends to surprise business owners the most when they first sit down with you to explore more creative tax strategies? That's your sort of your superpower is creative tax planning. So what's kind of the eye opener for them when they first sit down and talk with you?
I think the biggest eye opener would be realizing um, how much they probably overpaid in the past. Um, when they hear about different ways of doing things that they didn't know about, realizing that they could have implemented some of these things earlier. Most of these, I mean, there's a few things that you can go back and do amended returns and get retroactive relief, but for the most part, you kind of have to do tax planning going forward.
Yeah, retroactive tax planning usually is not the best strategy to
Yeah,
implement. So I have a lot of folks, this podcast is listened to by people across the United States and Canada.
right. Yeah.
So for my friends and colleagues who are listening from Canada, what is it about the US tax regime from your standpoint that makes it so attractive for entrepreneurs looking to establish a business here in the United States? And we literally just did a podcast on US business owners looking or Canadian business owners looking to move to the United States. But from
Right,
your
right.
standpoint, for someone listening to us, in Toronto or Montreal or Halifax, Vancouver, Calgary, or so on, and they're listening, and
Okay.
what makes the U.S. tax regime so attractive for entrepreneurs?
Okay, yeah, and I don't know all the Canadian tax
I
laws,
wouldn't
but
expect you to. So,
however, the U.S. is very well known for businesses. They have a lot of pass-through entities, LLCs, S corps, partnerships, where you can avoid double taxation. So those kind of entities, all the profit flows through straight to the individual, the owners, and you don't pay a tax as a company, as opposed to a C corp, you would pay a corporate tax, and then you'd basically get double tax because then you have to pay tax again on your own. But with the LLCs, the S corps, and the partnerships, all that income doesn't get taxed at that level, but it flows through to the individuals. Um, and there's other benefits. There's like low, if you do have a C corp, there's a low corporate tax rate. which is 21%. And we also have low capital gains rates of 20, maximum of 20%. Um, and we also have some aggressive depreciation rules. There's Section 179 and bonus depreciation, things like that. As well as there's a credit called QBI credit, Qualified Business Income Credit. For these small businesses, they can get a 20% credit on their income, which knocks down their tax rate. So those are some of the things that are kind of specific to the U.S. tax law.
Okay, so we're discussing today the three questions intelligent business owners should ask about creative tax planning. So, Mike, here we go. Why don't we get right to our questions?
All right.
Okay, question number one. I've been in business for 20 years and now I'm thinking about selling my business and retiring. What is the best way to sell my business and pay the least amount of tax possible? Well, Mike, this is right down your alley, so I'm handing it over to you.
Okay, yeah, well, there's a way to actually pay zero tax if you have the right size business. There's a section 1202 business. It's a qualified small business stock type business. And actually with the new Big Beautiful Bill Act, they increased the maximum, like the small business used to be we used to be able to exclude $10 million from tax. Now you can exclude up to 15 million. And the size of the business can be up to $75 million in assets. So if you plan it right, if you set it's all based on the structure. If you set up your structure, your business, especially if you do it 5 years ahead of time, you could sell your business and pay zero tax on the gain from that business.
That was actually my follow-up question. You kind of answered, but that's okay. It was how important is the timing of the sale and the structure of the deal when trying to minimize taxes? So you're
Right.
saying that you want to have at least a minimum 5-year runway would be what you would recommend.
That would be ideal. However, with the One Big Beautiful Bill Act, they actually just made some changes to that as well. You used to have to keep it for 5 years or not get any advantage, but now they have a tiered system. So after three, if you hold it for 3 years and then sell it, you could get 50% of it excluded from tax. If you hold it for 4 years, you get 75%, and then 5 years you get 100% excluded. So that's brand new as of last year.
So the timing again is really key. So it's not you wouldn't recommend an impetuous business sale. No tax advisor you ever met or anybody would recommend it. I'm going to sell
Right,
it
right.
tomorrow. So time can be your friend if you use it.
And
Uh,
it's
Go
also
ahead.
important to if you're going to convert from an LLC, for an example, to a C corp, so you can take advantage of this, you need to obviously do it at least 3 years ahead of time. But you also need to, if when you're doing a conversion, make sure you're getting the best value for your assets, value your assets for the conversion at the right time for that, so you can take full advantage of the gain exclusion.
So that conversion from an LLC to a C corp, is that I can just hear the question now. The business owner is going to say, well, is that in itself a deemed disposition? In other words, when they do that transition from LLC to C corp, is that a taxable event or is that a flow through to the C corp?
No, that would not be a sale in itself. It would
But
just be a change.
you're just structuring the business up so it can be ready to be sold. That's
Right, right. Yeah.
I would say just my only comment to all of this that when it comes to this gentleman who's talking about selling his business, obviously as Mike's alluded to, there's some really important tax planning questions asked, but a business owner who's thinking about selling their business and retiring will want to consider their future cash flow needs. I would also add on top of that their estate and legacy planning goals. And
Right.
in addition to that, they're going to want to implement a risk management strategy. We always hope for the best and the blue sky ending. We live into our 95 years old and fall asleep at night and pass away, and it's all really kind of innocuous. But the reality of it is that things don't always work that way. And some of the biggest financial risks that people are going to experience in their lives will be the fact that they do have longevity.
Right,
And we saw here a little while ago, but the impact of inflation on the cost of goods.
right, right,
And then, this whole idea of, of longevity comes with another risk, and that is the risk of getting sick and not dying. You
oh,
know,
right, right,
so you want to make sure that all this planning you're doing, this retirement planning and selling the business and realizing all this capital, that you've kind of put a Teflon ball around yourself, protected yourself from all these things. So having a proper estate plan, it takes into consideration your legacy goals as well, if you do have those. Making sure you have capital forecasting so you can see the spending rate of your money so you don't end up mistakenly being a little over aggressive on spending too soon, and making sure that you're protecting yourself and the people that you love. So that's just
right,
my
right.
2 cents worth on all of this. And I'm sure when you're talking with clients that these things come up in your conversations with them as well, or at least I hope they do.
Yeah, I was going to say that's how you and I work together because the reason that we help people save on their taxes is to build their wealth and to meet their goals. So you need to, like, both of us need to find out what our clients' goals are. Like, if you're trying to sell a business, what is your goal? Do you want a certain amount of money per year? Do you want to give to charities? What are your goals? Do you want to give it as an inheritance? What are you trying to accomplish? So in addition to the 1202 corporation strategy, there's also other strategies where you can defer your gains and things like that over several years. You can give to charitable organizations, that type of thing.
Our topic today is the 3 questions intelligent business owners should ask about creative tax planning. And joining me on the podcast from West Palm Beach, Florida, is Mike Anthony. He's a CPA. He's also a strategic tax advisor to business owners and high-income professionals. Okay, Michael, let's move on to question number 2. I'm currently looking at a real estate for an Airbnb rental. What tax planning strategy should I implement to coincide with this acquisition? Mike? Over to you.
Mm.
Somebody wants to buy a property for Airbnb.
Yeah, that's a very hot topic right now, and it's a great strategy that's being utilized by a lot of people. Um, One nice thing, I mean, we actually do use loopholes once in a while. They're legal loopholes, but this is called the short-term rental loophole. Ordinarily, like if you get rental property and you lease it like a 1 year lease, that would all be considered either passive income or passive losses, and you cannot offset your ordinary, like your W-2 income. You could not offset that with passive losses. However, this is great for like maybe high earner W-2s. So the short-term rental loophole involves like an Airbnb, if you have an average of 7 days or less rented uh, for your property, and then you do like 100 hours of managing, 100 hours a year of managing the property yourself, or you do more than anybody else that like you're not using a management company to do everything. You would qualify basically as a real estate professional. So that automatically puts you into the category of active. So when it really comes into play, let's say you bought an Airbnb and then you claimed a lot of depreciate. The first year you didn't have a lot of income. You had a lot of expenses to get it started. Maybe you did a cost segregation, got a lot of depreciation. So you got a big loss basically on purpose the first year. But that loss wouldn't do you any good if it was all passive loss. So if you had W-2 income and you have passive loss, they're not gonna offset each other. However, with the short-term rental, you have 100 hours logged, which is not impossible to do even as a W-2 person. Um, you could take that big loss from your rental property and decrease the ordinary income from your W-2 wages and have much lower taxes.
Interesting. So talk a bit more about the depreciation strategy or the cost segregation strategies that would make a difference again in a short-term rental like you just discussed. How does this all work?
So yeah, the cost segregation it sounds more complicated than it is, but you do have to hire like engineering firm. So you'd buy a rental property. The whole building might be you bought it for 500,000, let's say. However, the IRS depreciation guidelines would require you to take like 1/30th of that depreciation every year. But if you hired the engineering company to go in and they could break down the house, like maybe half of the 500,000 is really building structure, but you have windows, you have doors, you have cabinets, you have furniture and fixtures, you have washer and dryer, you have driveways, you have landscape. And a lot of those items are actually 5, 7, 15-year property under the depreciation code. And now with the one big beautiful bill, we can take bonus depreciation on that. Anything 15 years or less, we can take bonus depreciation of 100%. So let's say half of the building is really the building itself. The other $250,000, you could take 100% depreciation on that and all in the first year. You don't have to wait 30 years to do it.
I got to introduce you to a friend of mine. He was actually on my podcast here a couple of times. His name is Joel Dobrin, and he
Right.
is a cost segregation expert. He works with clients all over the United States. So that's somebody you've got to meet.
Oh, there you go. Yeah.
Good friend of mine. Are there any common, you would know this, are there any common pitfalls for new Airbnb investors that they should really avoid? And I'm talking from a tax perspective, but is
Well,
there any
yeah,
sort of ignorance is bliss and mother of
yeah.
adventure things that they need to be careful of?
Well, I know you're saying from tax perspective, but obviously, just business wise, you want to make sure it's going to be rented out, it's in a good area. But you also have to check the local laws, make sure it can be rented as
That's the thing I think about when you were mentioning about the short-term rentals. There's some places now that absolutely forbid even their bylaws now forbid short-term rentals. So you got to be careful of that.
right. Oh, yeah, right. Yeah.
From
So,
the administration part of it, I was thinking, are there any tax-related shortfalls or pitfalls they want to be careful of as well?
yeah. I guess the biggest one would be, well, you have to make sure you log everything, keep good records, documents, but also if you're going to buy it and then resell it right away and not buy another one, you just have to realize like if you took all that depreciation in 1 year and then you sold it the next year, you would have to recapture that depreciation the next year. So um, it might not be the best idea to do maybe a cost segregation if you're going to sell it immediately. However, there are other ways to get around that, like a 1031 exchange, something like that.
Okay, Michael, let's move on to question number three. Last year, my business paid almost $1 million in federal income taxes. Is it possible to reduce my tax bill to zero or close to it while staying just as profitable as I was last year? And I'll just say, for someone in this position, what is the first step you would recommend they take as they explore these options? So I'm going to turn this all over to you. I know this is right in your wheelhouse, Mike. So I'm going to hand it over to you.
Okay, yeah. So yeah, the reason I got into the tax strategies in the first place, I'm working with a group called Tax Strategists of America, and they're the ones that have this pathway to zero. We have a formula and a plan. If somebody really wants to get their taxes down to zero, we work with a former IRS agent. She used to audit people all the time. She came up with a specific plan, strategy, and formula to it's a combination of acquiring businesses and acquiring real estate property and using the personal and business strategies for each one to your advantage to eventually get to a zero tax bill. For example, you more or less need to acquire or start a business in any case to really take advantage of some of the tax strategies. But you would start or acquire a business, then you would implement personal tax strategies. Personal tax strategies would be things like Augusta rule. You could rent your business can pay you rent to rent your house for business meetings for
Hmm.
14 days. Your business gets a tax deduction, but you don't have to claim the income for the 14-day rental. So that's like free money right there. and you get a tax deduction on your business. There's other things like SEP retirement accounts, accountable plans. One of the basic ones is S corps. The structures are a big thing. There's a lot of people that are LLCs or sole proprietors, even LLCs, partnerships. Um, if you if you're not an S corp and you're making money, you're paying self-employment tax on all of your income. I mean, it's nice that your income is all flowing through to your personal, but if you're not an S corp, you're paying 15% self-employment tax on all the income that flows through to you. So that's a big strategy. People probably,
So,
if you're making,
so at what level? Here's a question for you on that one. Where's it become the real issue for the on the S corp side? How much income would someone need to? Where does it kind of become a real advantageous? Because I have quite a few self-employed friends,
right, right.
right? So not
So,
all of them are making, 500 to $1 million a year. Some of them are making $120,000 a year. Some are making $250,000 a
right,
year.
right, right.
Where at what point would you say, well, if you're earning fill in the blank or more, you should be looking at this S corp. Where do you think that line in the sand would be?
I would say generally I tell clients if you're making over 40 to 50,000 net income, it's definitely to your advantage to set up an S corp as long as you're going to continue and grow from there.
Yeah, yeah.
Probably
Interesting.
the only real disadvantage of setting up the S corp is then you have to pay somebody to file your S corp return. There's a
Yeah, but I
second
mean,
return. Yeah. So
Michael, you're right here. I mean, we could I mean, we're not talking about a first male-born child here to fill out a secondary S corp return here.
but it's crazy how much people can save on that if you're making $100,000 net income on just a small business. Like you might have started a business this year and all of a sudden you made $100,000. And before you know it, you didn't have an S corp. And then you're paying $15,000 in self-employment tax that you don't have to pay.
Interesting.
But the other side of it is you need to set up the S corp and then also have a reasonable compensation. So you would
So
pay
say,
your
okay, so we're here in the first quarter of 2026, right? So let's just say someone listening in on the podcast going, "Hey, wait a minute, I'm not doing that." Is it too late now to start, or is this only work beginning in 2027 going forward?
Yeah, actually, it's not too late. Ideally, you would do it in the first 2.5 months of the year. However, there's a late election option. So we could actually go back, file a late election option for an S corp and go back to the beginning of the year.
So you're saying anything over like 50, $60,000, if a business owner is netting over $50,000 a year in a business that they're the owner of, they have an LLC most likely, they should consider an S corp.
But yeah, I would say 40 to 50 because
Okay, noted.
on you do get some credits like you get QBI and you get a few different credits. So it's not critical under 40,000, but I would say definitely once you get higher than that.
Fascinating. Well, Michael, based on our conversation today, what would you say? And we've covered a lot of really interesting stuff here.
Yeah.
What is one practical step a business owner can take right now if they want to start exploring, and we'll call it a more creative tax planning strategy? What do you think would be
Well, I,
the thing they could do right now?
I would say this is the perfect time to start doing some tax planning. Most people wait to the end of the year, and then the CPA gets the tax return. It's all based on whatever you did last year. You have all the CPA can do at that point is try to come up with other deductions. And deductions are not strategies. You need to plan for strategies this time of year. This is the perfect time of year. Tax season just ended. People probably paid more taxes than they wanted to or needed to. That's the crazy thing. Like one person could file a tax return one way, and the other person could file it, and or especially if they implemented a couple strategies, they'd pay a lot less taxes. It's kind of like when you go to a hotel, somebody pays $100 a night, somebody's paying $500 a night. Like, why do you want to pay $500 for the same thing?
Fair enough.
So,
So,
but basically, to answer your question, the group that I'm working with, we have a tax treasure. We call it the Great American Tax Treasure Hunt. where we'll have an all-inclusive tax planning tool where we can go through 100 different strategies and help guide you, and even things like exit strategies, things like that, reasonable compensation, QBI maximization, that kind of thing. So,
That's
but the thing is that, as you mentioned, this is the time. This is the time of year to do your planning and set up your strategies.
interesting. So for those who are watching, I'll say right now, there's gonna be a lot of people who are going to raise some eyebrows here. So for those watching, we've included all your contact information right below you on the screen. They can see how to get a hold of you. But we got a
Okay.
lot of people listening in on Apple, on Spotify. They could be driving in their cars, out for a walk, however it is. And they're just listening to us. So for those folks who are listening in, what is the best way for them to get a hold of you?
My email, I guess you have on the screen,
Yeah.
Mike at myrevive, MYREVIVE pro.com.
Mm-hmm.
Or I don't know what other contact information
I
you
got
have.
your phone number, and I got a website. I got the myrevivepro.com website. I've
Right.
got your email address, and I got a phone number as
My phone
well.
number is fine too. Text me or call me 561-427-3833.
There we go. We're all set. Mike, I want to
Okay.
thank you so much for coming on the podcast with me today. You were awesome. You provided great information, and looking forward to keeping in touch. Mike Anthony joined us today from West Palm Beach, Florida. He's a CPA, a strategic tax advisor. If you listened, you could see that for sure. And he works with business owners and high income professional. Mike, thanks a lot for joining us today.
Thank you, Wayne.
I look forward to bringing you the Three Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification when our latest episode has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we'll see you soon.